So in terms of the, risk, relationship-based banking versus lending, when we talk about relationship-based banking today, we're referring to the provision of financial services by financial institutions for the objective of obtaining firm-specific information or borrower-specific information through multiple interactions. So basically, how does the financial institution interact with their borrower base? Now, in contrast to that, or in addition to that, what is risk-based, relationship-based lending, which is what I'll let Joe discuss.
Thank you, Jay, and welcome everyone. Glad to have you all here. When we're talking about relationship-based lending, we're talking about the relationship that the bank or the lender has with the borrower, in addition to just knowing the financial statements and the information they normally gather in order to make a loan. They also know or have a strong relationship with the borrower, which gives them better insight as to what the borrower can do and how their business is truly focusing. Now, there is a pitfall to that, and that is if the lender gives more credence to the borrower than the actual financial results. And we've seen this many times where lenders will listen to a borrower and take the information the borrower is providing when, in fact, the financial statements are showing a different trend. And the borrower will obviously try to convince them that that trend is changing or moving back to a positive direction or whatever the case may be. And that becomes very concerning when the lender, as I said, gives more credence to the borrower than to the actual financial statements or written documents they have. And again, the true relationships in all of this is not just having the borrower's loans, but also having their other accounts so that you can tie all these things together. In relationship-based lending, I would say that for many years, and probably for years up until about maybe 5 years ago or in that time range, smaller financial institutions, community banks, had a much better grasp at this and had an edge, and I would say a pretty secure edge at one time over larger financial institutions. Now, that's changed over time as the banks, the bigger banks, have moved into what they call business banking, and they're really focusing on small businesses and developing almost an internal community bank within the bigger bank. And a couple of banks that have been doing this pretty well recently. I know Wells Fargo is working very hard at this, as is U.S. Bank, and Chase has started a program recently that they're trying to really emphasize going after these smaller businesses. The other thing that's making it probably a little more difficult for the smaller institutions is technology itself, and that is that what used to be technology for big companies such as all the treasury management services and cash management services and so on, those now, with the technology as it is now, the bigger banks have really focused on being able to provide that same product capability to smaller businesses or something very similar. And community banks are trying to move this way. Unfortunately, most community banks are hampered by this because they are using one of the big core systems to run their systems, and they're at the mercy of the core system providing this information or going out and buying it and trying to link it in together.